Two coworkers compare credit scores over lunch. Both have paid every bill on time for 3 straight years, no exceptions. One sits at 790, the other, doing the exact same thing, sits at 646. Same behavior, 144-point gap. The one at 646 figured on-time payments were the whole game. Pay in full, pay on schedule, watch the number climb. That's not wrong. It's just a fraction of the real picture. And the missing pieces are what quietly cost him nearly 150 points. The one at 790 didn't manage money any better day to day. He just understood that a credit score isn't only reading your payment habits, it's reading a handful of other signals in the background, signals that can drag a score down, even while every single payment lands exactly on time. Here's what those signals actually are, and what to do about each one. Every time you apply for something, a new card, a car loan, even a phone plan that pulls your credit, the lender leaves a mark called a hard inquiry. Each one costs a handful of points, usually somewhere in the single digits, and stays visible on your file for up to 2 years, though its actual weight fades much sooner than that. One inquiry barely registers. The damage comes from stacking them. A store card at checkout, a new phone a few weeks later, a car loan the month after. None of those individually should tank a score. But 3 or 4 inquiries clustered together read differently to the algorithm than 3 or 4 spread across a year. It starts to look like sudden, urgent need for credit, and that's exactly the pattern the score is built to flag. Fix, space out applications where you can. If you're genuinely rate shopping for one loan, a mortgage, an auto loan, do it inside a tight window. Most scoring models are built to treat several inquiries of the same loan type within a couple weeks as one shopping event, not several separate applications. Closing a credit card feels like tidying up. Fewer accounts, less clutter, one less thing to think about. It's also one of the more common ways people accidentally sabotage a score they were trying to protect. The moment an account closes, 2 things shift at once. Your total available credit shrinks, which pushes your overall utilization percentage up, even if your spending hasn't changed by a single dollar. And if that card happened to be one of your oldest, you start losing part of what it was contributing to your average account age, a number that doesn't recover overnight. Since it's built from years, not weeks. Fix, if a card carries no annual fee, let it sit open with a small recurring charge running through it instead of closing it. Save the closures for cards that are actually costing you money to keep. If your oldest account is under 2 or 3 years old, your score is working off a thin stack of evidence, and thin stacks swing harder than thick ones. One missed payment, one utilization spike, one new inquiry, all of it carries more relative weight, because there isn't a decade of steady behavior sitting underneath to absorb the hit and smooth it out. This has nothing to do with anything you did wrong. It's closer to a small sample size problem than a character problem. A score built on 2 years of data reacts sharply to a single bad data point. A score built on 15 years barely notices the same thing. Fix, there's no shortcut around time, but knowing your file is thin means treating every other factor with a little more caution, since there's less cushion underneath to catch a mistake. Scoring models reward you, in a small way, for successfully managing more than one kind of credit: revolving accounts like cards, and installment accounts like a car loan or a mortgage. So finishing off a loan completely, something like paying that last car payment, is a genuine financial win. It can also cause a small, temporary dip right after. Nothing went wrong. The account simply moves from open to closed, your mix of active credit narrows slightly, and the average age math recalculates. It's a real, if minor, side effect of doing something responsible, one that surprises people, because it looks, for a moment, like the score is punishing good behavior. Fix, nothing to actively fix here. The dip is usually small and short. The move is just knowing it's coming, so a good financial decision doesn't get mistaken for a warning sign. Getting added as an authorized user on someone else's well-managed card can genuinely help a score. Some of that account's positive history gets reflected on your file too. What people forget is that the arrangement runs both directions, and not always in your favor. If the primary cardholder misses a payment, runs the balance high, or closes the account, that shows up on your report as well, even though you never touched the card and never missed a single payment anywhere in your own name. You inherited the upside when you signed on. You inherit the downside too. Fix. Only stay attached to accounts you'd trust with your own money. And check in occasionally on how they're actually being managed. If the situation changes, ask to be removed rather than staying tied to a card you don't control. Here's the one almost nobody accounts for. Say you've got healthy habits, pay everything in full, never carry a balance. Then a large one-time expense hits right before your card's monthly reporting date, a flight, a deposit, furniture, anything sizable. Your card doesn't wait to see whether you'll pay it off. It reports whatever balance existed on that one specific day of the month, and if that day happened to land right after a big charge, your reported usage spikes for that cycle even though the balance is gone entirely by the time payment is actually due. The habit didn't change. The timing of one purchase did. Fix. If you know a large charge is coming and it's close to your card's reporting date, either delay the purchase a few days if you can, or make an extra payment before that date to bring the reported number back down. Here's the part that trips up even careful people. Your score isn't measured against some universal standard. It's measured, in part, against everyone else applying for credit at the same time. Lending standards tighten and loosen with the broader economy, and scoring models adjust with them. During periods when default rates rise across the board, models can shift to weigh risk factors more heavily, meaning the exact same utilization, the exact same account mix, can score slightly differently than it would have a year earlier. Nothing about your behavior changed. The environment around it did. Fix. There's genuinely nothing to fix here. It's a reminder to watch trends over months, not obsess over single-point swings you can't fully explain, since some of what moves the number isn't about you at all. Back to the coworkers. Same payment discipline, same 3 years, 144 points apart. The one at 790 wasn't better at paying bills. He just knew that a credit score reads more than payment behavior. It reads inquiries, account age, credit mix, who you're financially attached to, and even timing you'd never think to watch. None of these 7 reasons ask you to spend less or pay more. They ask you to space out applications, keep old cards breathing instead of closing them, know who's on your accounts, and pay attention to timing on the occasional large purchase. Keep paying on time. That part was never broken. Now go handle the 6 things nobody told you were also being graded.